Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Futu Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community, starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. Please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So I want you to imagine logging into your portfolio, sipping your morning coffee, and seeing a third of your investment just completely vaporized overnight.
Yeah, that is a horrible feeling.
Right. It's exactly what investors in today's company woke up to. We're talking about a catastrophic 28 to 30% gap down.
Just massive.
And the trigger for this whole shock to the system was just a single terrifying headline. China proposed a staggering $271 million penalty over alleged, quote, unlicensed operations.
And that one word, unlicensed, that's enough to make anyone freeze.
It really is. It feels like a sudden fatal blow.
Yeah.
So, our mission today is to figure out the reality beneath that headline. Are we looking at a permanent regulatory death sentence here? Or, and this is what we really want to know, is this a massive market overreaction that has actually created a rare contrarian value play?
Well, that is the million-dollar question, isn't it? Because what we are seeing right now is it's a classic textbook panic response.
Oh, absolutely.
The market algorithms, retail traders, they see the words China, penalty, and unlicensed, and they just hit the sell button first and ask questions later.
Right. Get out now, figure it out tomorrow.
Exactly. But when you synthesize what is actually going on underneath the hood of this company, the picture becomes, well, a lot more nuanced. To really understand this, we have to separate the emotional, visceral reaction to a massive fine from the structural reality of the business model itself.
All right, let's move into the wealth building context because, it's incredibly easy to look at a 30% plunge and treat this like some highly volatile meme stock that just had its bubble burst.
Yeah, people love to draw that comparison.
Right, but when a meme stock crashes, it's usually because the underlying fundamentals were an illusion to begin with. But that is not what Futu Holdings is.
No, not at all.
This is a foundational high-margin platform for both mainland Chinese and international investors. So for a long-term investor listening right now, how should we be framing this? Because my analytical brain immediately goes to an analogy of a top-tier, globally systemically important bank.
Okay, I like that comparison.
Think about when one of those legacy mega banks gets hit with a multi-billion-dollar fine for, say, compliance failures.
Which happens fairly often, yeah.
Right. The stock plunges, the weak hands panic and sell, but the underlying bank still holds the deposits. It still collects the interest. It still processes millions of transactions daily. The actual utility remains intact. So is a structural panic like this actually a long-term wealth-building setup?
If we connect this to the bigger picture, your bank analogy is incredibly apt here because long-term portfolio growth often comes from identifying these incredibly sticky financial ecosystems that have just suffered a massive sentiment reset.
A reset, right.
Provided, and this is the essential caveat you have to remember, provided the core business model isn't permanently broken, Futu isn't a flash-in-the-pan speculative asset. They process a massive constant volume of global trades.
They're a utility.
Exactly. They act as a vital utility for capital flow. So from a wealth-building perspective, when an asset with real, quantifiable utility goes on a 30% discount strictly because of a regulatory headline, growth-focused investors don't just walk away in fear.
Right, they dig in.
They dig into the mechanics to see if the earning power is permanently impaired or if it's just temporarily taxed.
So you're comparing them to a systemically important bank surviving a fine. But for that analogy to actually hold water, the underlying engine has to be just as robust.
Sure.
Now let's look at the fundamentals. When we look under the hood at their 2024 financials, does the math actually support that resilience?
It absolutely does.
Yeah.
Let's unpack the mechanics of their financials, because prior to this shock, the trajectory was incredibly strong. In the 2024 fiscal year, their total revenue hit 13.0 billion Hong Kong dollars. Yeah, that growth was driven by a massive surge in average daily client trades and high-margin financing interest. But the metric that really demands your attention here is their operating margin. They consistently hover above 40%.
40% operating margins in the financial sector is massive.
It really is.
I mean, how are they achieving that kind of profitability when traditional banks struggle to hit, like, half of that?
It comes down to the architecture of their business model. That 40% margin is the hallmark of a scalable, tech-driven digital brokerage.
Ah, right, because they don't have the physical footprint.
Exactly. Think about a traditional legacy bank. To expand, they have to lease physical real estate, build brick-and-mortar branches, hire local tellers, staff regional compliance officers.
Their fixed costs are just astronomically high.
Precisely. Futu's platform, on the other hand, is purely digital. The marginal cost of adding an additional user to their system is almost zero. Once the server infrastructure and the trading algorithms are built, every new trader they onboard drops straight to the bottom line. So yes, a $271 million penalty is going to create a really ugly one-time distortion on their GAAP accounting.
Just to clarify for anyone who might not live in financial spreadsheets every day, when you say a distortion on their GAAP accounting, you mean the generally accepted accounting principles.
Right.
Basically, the official rules dictate that they have to write off this massive fine as a lump sum expense on their income statement, which might make their quarterly earnings look negative on paper.
Exactly. The headline earnings per share for that specific quarter will look terrible because of those accounting rules. But operationally, the cash-generating machine itself, the digital infrastructure processing those trades, remains highly efficient and incredibly resilient.
And we also have to talk about their financial health, because an accounting write-off is one thing, but a cash penalty of that absolute size would literally bankrupt a smaller player.
Oh, without a doubt.
But looking at the data, Futu has a fortress balance sheet. As of their latest filing, they were holding 8.5 billion Hong Kong dollars in corporate cash and cash equivalents.
Yes.
And we need to be completely clear here. That is their corporate operating cash. It is completely segregated from their clients' trading assets.
That is a crucial distinction.
Right. And historically, they generate over 4 billion Hong Kong dollars in free cash flow annually. So mathematically, they can literally write the physical check for this $271 million fine out of their existing reserves and just keep operating without missing a beat.
Yeah, the cash is there.
But beyond the cash, they also have a massive competitive advantage with their Moomoo ecosystem, right?
Yeah, and what's fascinating about Moomoo is how it completely redefines user retention. It isn't just a basic brokerage app where you press buy and sell and close your phone.
Right, it's not a bare bones interface.
Not at all. Moomoo operates as a comprehensive social investing network. It integrates deep quantitative analytics, customizable screener algorithms, community forums, and real-time institutional data. This architecture creates incredibly high switching costs.
Let's dive into that user experience, because I think switching costs is a term thrown around a lot, but what does that actually feel like for the user? I mean, it's not just about transferring cash to another broker, is it?
Not at all. The friction isn't just financial, it's psychological and operational.
Okay, how so?
Well, if a user decides to leave Moomoo, they aren't just moving their money. They lose their highly customized trading algorithms. They lose the specific social network of traders they swap daily ideas with. They lose years of tailored historical data and watch lists.
Oh, wow.
It's like asking someone to delete their entire Apple iPhone ecosystem, their photos, their synced apps, their passwords, and start over on a basic flip phone.
That is a great analogy.
The pain of leaving is simply too high. This anchors their assets under administration, even when the broader market gets choppy or regulatory headlines get scary.
Hold on, though. I hear you on the sticky ecosystem, and having cash in the bank is fantastic. But a $271 million fine isn't just a parking ticket.
True.
Doesn't a penalty of that absolute magnitude fundamentally kneecap their ability to generate revenue going forward? I mean, are we looking at a permanent impairment of their earning power, or is this really just a massive one-time speeding ticket?
That brings us to the catalyst timeline, because your question is precisely what institutional analysts are trying to model right now.
Right.
The ultimate test for this company will be their upcoming Q2 2026 earnings report. Analysts are currently slashing their forward estimates, pricing in the absolute worst-case scenario.
Preparing for the worst.
Exactly. But here is the crux of the growth thesis. If management comes out during that earnings call and explicitly confirms that the fine is strictly a one-time event, and more importantly, that their assets under administration has stabilized despite the terrifying headlines,
Then what happens?
it could spark a massive relief rally. The market just needs undeniable proof that the engine isn't broken.
So ultimately, what the market is waiting for is the transition from uncertainty to certainty.
Precisely. It's a known psychological quirk of the market. It hates uncertainty far more than it hates bad news.
Yeah, that makes sense.
Right now, this $271 million fine is officially listed as proposed. The regulatory overhang is incredibly heavy because the market imagination runs wild with what could happen next.
Oh, for sure. People assume the absolute worst.
But once that fine shifts from proposed to settled and the ink is dry, that specific regulatory dark cloud vanishes. The worst-case scenario transforms from a scary unknown into a known, quantifiable number on a spreadsheet.
And there are macro tailwinds developing in the background that could accelerate that recovery too.
Yeah.
We're looking at potential interest rate cuts by the People's Bank of China or the Hong Kong Monetary Authority.
Yes, that's huge.
Let's explain the mechanics of that. If central banks cut rates, it makes borrowing money cheaper. For a brokerage like Futu, cheaper borrowing naturally stimulates margin financing, meaning traders are more willing to borrow money to leverage their trades.
Right, which drives revenue.
Exactly. That acts as an organic, structural boost to their revenue that could completely offset any temporary slowdown in user growth caused by the regulatory drama.
And we should also briefly touch on the speculative rumors currently circulating in the fintech community.
Oh, the restructuring rumors.
Yeah. There's quiet chatter that Futu might negotiate the penalty down, or more importantly, structurally separate its mainland-facing marketing entity from its Hong Kong licensed brokerage.
Which would solve the regulatory issue.
Exactly. If they reorganize their corporate structure that way, they could legally resume core operations and satisfy the regulator simultaneously.
You know what I find so ironic about how market psychology works is that the actual physical payment of a massive 9-figure fine might paradoxically be the exact catalyst that triggers the stock's recovery.
It's crazy, but it's true.
You pay over $250 million and your stock goes up simply because the uncertainty is finally dead.
It's the ultimate sell the rumor, buy the news dynamic just applied to regulatory punishment instead of a product launch.
Now let's pivot to the chart because that exact dynamic pricing in the absolute worst case scenario is perfectly reflected in the technicals.
Yeah.
And what we are looking at on the screen is incredibly violent.
Very violent.
We're looking at a plunge from the $120 range all the way down to the 80s in the blink of an eye. From a structural mechanical standpoint, what is actually happening in the market's order books when a stock falls out of the sky like that?
We're witnessing what technical analysts call a washout structure. Think of a washout structure like a controlled forest fire.
Okay.
It looks absolutely devastating on the surface, but it instantly burns away all the dry brush. In market terms, the dry brush is all the over-leveraged retail traders, the tight stop losses, and the panic sellers. When you have a single event gap down of this magnitude, it creates a phenomenon known as climactic volume.
Let's break down climactic volume. That essentially means everyone is rushing the exit door at the exact same millisecond.
Right, exactly. When the news hits, cascading stop-loss orders trigger automatically. The selling pressure compounds on itself algorithmically. It forces out all the weak hands simultaneously.
Wow.
And what that creates in the order book is a selling vacuum. Once that initial burst of panic sellers is gone, there is literally no one left to push the price lower.
Right. Everyone who wanted to sell is already sold.
Exactly. The fuel for the fire is entirely consumed, leaving fertile ground for institutional smart money to come in and plant new seeds at bargain prices.
And it seems like the major analysts might actually be helping to put a floor on this fire. Jeffy Horgan issued a drastic downgrade recently, cutting their price target all the way from $300 down to $87.
Yeah, that was a brutal cut.
But surprisingly, that $87 target seems to be acting as a capitulation anchor.
It is. It's like the collective market is looking at that report and saying, okay, even the most pessimistic, bearish institutional view on Wall Street says the core business is still worth $87. It completes what we call a measured move.
And a measured move is essentially a predictable exhaustion point, right?
Yes, a measured move is a technical analysis concept where an asset falls by the exact proportional distance of a previous technical pattern. It signals to institutional trading algorithms that the mathematical downside of the panic cycle is likely complete.
So it stops the bleeding.
Right. It caps further downside
Hmm.
and actively invites institutional value buyers to step in and absorb the remaining shares.
But let's be real about the psychology here. Catching an asset that's in free fall is terrifying. It's incredibly dangerous.
Oh, for sure. Catching a falling knife.
Exactly. A 30% drop on high volume looks like textbook exhaustion on paper, sure.
Huh.
But how do you know this isn't just a trap? How do you know the selling pressure won't just resume next week once the dust settles?
So what does market sentiment look like? To answer that, we really need to look at what's happening beneath the headlines. If you look at the surface, the mood is decisively, overwhelmingly bearish.
Yeah, totally.
Look at the financial media. They are using aggressive words like collapsed, crashed, and plunged. Analyst actions, like that JP Morgan downgrade to neutral, show a near-term institutional retreat. On the surface, it looks like a highly toxic asset.
But if we look beneath the surface, what is the smart money doing?
Beneath the surface, we have to rely on historical precedent. If we look back at past Chinese ADR regulatory scares, think about the massive crackdowns on companies like Didi or Alibaba. Peak regulatory fear almost always correlates with stealth institutional accumulation.
Really?
Yes, the smart money simply does not buy when everything is rosy, the skies are clear, and valuations are expensive. They buy when retail investors are utterly terrified. Now, to be fully transparent, we don't have the Form 4 filings confirmed yet for this late May crash.
Right. And a Form 4 filing is the official SEC paperwork that legally requires company insiders and major institutional holders to disclose when they're buying or selling shares.
Exactly. Since we don't have those official documents yet, we can't definitively legally track the exact institutional money flow right this second. But the historical pattern during these specific types of regulatory panics is incredibly clear and consistent.
It essentially becomes a classic transfer of wealth. When the financial headlines scream collapse, retail investors usually panic and sell at the absolute bottom, right into the open hands of quietly accumulating institutions.
Yeah, they just vacuum up the shares.
The institutions provide the liquidity during the panic, they absorb the shares at a massive discount, and then they hold on patiently for the mean reversion rally. It operates practically like clockwork.
But this raises an incredibly important point about critical thinking. The institutions aren't just buying blindly because it's cheap. They are calculating the exact probabilities of survival. They're betting millions of dollars that the core business model isn't dead.
Now let's talk about the risks. Because we can't just assume every massive drop is a stealth buying opportunity. We have to respect the very real bear case here.
Absolutely.
And the most pressing issue isn't the $271 million fine itself. It's the existential regulatory risk that caused it. The penalty was levied for alleged unlicensed operations. The absolute worst-case scenario is that the China Securities Regulatory Commission, the CSRC, doesn't just fine them, but issues a permanent injunction.
Yeah, that's the big fear.
An injunction stopping them from onboarding any new mainland Chinese clients for overseas trading ever again.
And we have to be honest, that outcome would be devastating. The mainland flow has historically been the crown jewel of their growth engine.
Right.
If that artery is permanently severed, you aren't just looking at a one-time financial penalty, you are looking at a permanent structural impairment of their future growth rate.
Right. And if that injunction happens, there's an immediate secondary risk, client asset flight. If the headlines keep talking about unlicensed operations and massive fines, you could see a massive crisis of confidence among their user base.
Oh, a run on the bank.
A literal run on the bank scenario, yeah, where users log into the app and just start withdrawing all their assets because they're terrified the platform will become insolvent or that their individual accounts will be frozen by the government.
Those are highly valid, heavy risks. But we need to look at the structural mitigation factors the company has built to defend against exactly this.
Okay. What do they have in place?
First, on the growth side, Futu hasn't just been sitting still relying solely on mainland China. They have aggressively executed a global expansion strategy over the last few years.
Right, they've been moving fast.
They are actively operating and growing in Singapore, Australia, Malaysia, and the United States. While the mainland Chinese market is undoubtedly vital, this global infrastructure, combined with their deeply entrenched Hong Kong user base, creates a very solid, high-margin revenue floor.
So they aren't fully dependent.
Exactly. That floor arguably justifies a valuation well above these post-crash lows, even if mainland growth grinds to a halt.
And what about mitigating that run on the bank scenario?
Yeah.
How do they stop a panic withdrawal from bankrupting the corporate entity?
On the fear of insolvency, it is absolutely vital to understand the strict regulatory environment they operate in. Futu maintains incredibly strong compliance with the SFC in Hong Kong.
Which is a very strict regulator.
Very strict. One of the absolute strictest rules imposed by the SFC is the complete legal segregation of client assets from corporate assets.
Meaning they operate in entirely different bank accounts, walled off legally from one another.
Precisely. If Futu were to theoretically go bankrupt tomorrow, the client funds are walled off and protected. Because they have such strong historical compliance with these SFC segregation rules, a true run-on-the-bank scenario that destroys the corporate entity is highly improbable.
Okay, so a total collapse is unlikely.
Right. You might see some short-term compression in their assets under administration if people panic, but it would not trigger a total financial collapse of the firm.
So with everything on the table, what's the final verdict?
Based on all the research and the structural realities we've discussed, we are looking at a cautiously bullish score of 6 out of 10. This is definitively a high-risk, contrarian setup.
Right. Not for the faint of heart.
Definitely not. If you were looking at this, the target horizon is roughly 6 to 12 months, viewing it strictly as an event-driven regulatory recovery play.
Got it.
The core verdict is this. The market is currently pricing in a regulatory death sentence, but Futu's fortress balance sheet can easily absorb this fine. The immense resilience of the Moomoo ecosystem and their ongoing successful global diversification are being deeply underpriced by panic sellers.
The value is there.
Exactly. Once this fine is finalized, settled, and paid, the removal of that uncertainty makes a violent mean reversion rally highly likely. The fundamental earning power is simply too robust to remain compressed at these panic levels forever.
If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.